Hi, I'm Mal from the Money Study, bringing you another episode in our Ultimate PSS Education series, and we're starting to get into the nitty-gritty now because this is episode number 27, and what we're going to do here is to go through the steps of how you'd actually calculate a net pension, and this is for people who are retiring over the age of 60. I'll do the other ones a little bit sooner, a bit later, sorry. And we'll do this, but this one's for those people who are going to retire at 60 or over. And they're taking what I've called here a medium PSS pension. So it's not a very large PSS pension, it's not a small one, it's somewhere in between. Now your thoughts of what's big and small may differ, but that's really a bit irrelevant. What I'm trying to get across here is these pensions impact the taxation depending on their size. So I'm sort of doing examples to show you what these problems and what these things can indeed impact upon it. So before we kick off with the actual example, there's my disclaimer, the facts and the figures and so forth, but it's not anything to do with advice. This is information only for you to understand how the taxation is calculated. This is not tax advice. I'm basically spelling out how the tax is calculated on a PSS in this particular example. So, as we looked at in the previous episode, we're looking at the various different tax components. And because we saw that the different tax components were treated differently at different ages, then we need to work out what the size of these components are. Now, so this example is only for people who are retiring post 60. Okay, so what we're going to look at here is when we saw our chart, it's basically said that over 60, our tax-free was obviously tax-free. Our taxable taxed was also tax-free post 60. So the only bit that we really have to pay tax on is this taxable untaxed component. So we find on page 4 our tax components and we focus on the bottom one, our taxable untaxed component. And we take that number and we're going to put it into our worksheet. Now, if anyone hasn't got their worksheets yet, please just feel free to email us at admin@themoneystudy.com.au and I'll make sure you've got a copy of the worksheet. But if you've been following these episodes from the start, you're now familiar with it. And basically what we've done then is we've then put into row 12 the amount of our untaxed amount. So we put the $249,261 into row 12. So that's the first step, is getting our untaxed amount and isolating it. Then we want to do is what we try to do is work out how much of our total benefit, our total defined benefit, so this doesn't include transfer amounts and so forth, this is literally taking our money from our formula money, our defined money. We find that on towards the bottom of page 2. So it's our defined benefit amount. So we're trying to find out what is our untaxed component as a percentage of our defined benefit accrual. You will notice in this example that the untaxed amount is exactly the same as the employer component. Do not just use the employer component because it is not always the same, especially for people who started a long time ago and were in the CSS before the PSS, and then they got transferred across because they actually had some employer components that literally were indeed taxable tax components. So anyway, don't use the employer component number in our examples. Always use the untaxed, but we're trying to find our untaxed as a percentage of our defined benefit. So we put our defined benefit total into our row 13. So we have our untaxed, we have our defined, and what we're trying to do is find the percentage or the fraction of our benefit, how much of it, of our defined benefit, is untaxed. So literally, if we take row 12 and divide it by 13, we find out it's 0.569 as a decimal. Now 0.569 as a decimal, if you remember from your high school maths, is 56.9%, just multiplied by 100. So we've now found out what percentage is our untaxed as a percentage of our total defined benefit. So, yep, we literally took the 249, we divided it by the defined, and we get this 0.569, which is 56.9%. Now, of course, remembering that these tax components will indeed vary as time goes on. Literally because the tax-free component is increasing and decreasing depending on what the share market is doing. Because it can go backwards, as can that productivity amount, the taxable tax components as well. So these components will change, but generally speaking, they're not going to vary hugely, hopefully. And also, as they would normally become better, normally speaking, your tax-free would probably increase over time because of the extra level of contributions that you are making there, increasing your tax-free. But they will change, and hence the closer and closer and closer you get to retirement, the more accurate your net figures are going to be. But of course, what we're trying to do here is to get some sort of idea as what we could expect in 2 years, 5 years, 10 years, or in this example that we've been following through, 13 and a half years. Now, of course, the smaller this percentage, the better it's going to be, because this is the amount of the total benefit that's going to need to be taxed. So if this 56.9 was only 40%, well, that's wonderful, because literally we're only going to get taxed on 40% of our pension rather than 56.9. So the smaller this percentage you've found, the better off it's going to be. Okay, and of course, I say the more you contribute, if you've only been doing 2, 3s and 4s and 5% contributions, not only by ramping up your contribution are you increasing your overall benefit, you're also increasing the tax-free component because of the extra of the percentage of contributions compared to the total. So we found our percentage, and that's the first part. Then what it comes down to is we saw off the chart on the previous episode that when you're over 60, taxes payable on that untaxed component at normal tax rates, normal marginal tax rates, but you are provided with what's called a 10% tax offset. So let's step our way through this little scenario. So we've figured out that 56.9% of our pension, of our gross pension, which was 107,078 from our examples, if you take 56.9% of 107,078, you end up with $60,927. So out of the full pension, 60,927 has to be taxed. Hence, that is your taxable income. Your taxable income is now 60,000. So it's like you're working somewhere earning $60,000. You're not earning 107 in taxable income. You're grossing this 107, but your taxable income, what we're going to actually get taxed on, is only 60,000. Now, someone with an income of 60,000, that puts us into that 32.5 cents of the dollar tax bracket. That becomes your marginal rate, so to speak. Now, so therefore, what tax do we pay if you've got an income, taxable income of 60,927? Now, I don't know off the top of my head, so we're going to use a tax calculator. Now, you can find a very good tax calculator on the Money Smart website. Again, this website is put out by ASIC, got some really good calculators on there. And so we are assuming, like I said in previous sessions, we're claiming the tax-free threshold from the PSS. We're trying to maximise our benefit from the PSS. So we're going to use a tax calculator, assuming this scenario, to find out how much tax would we have to pay if we had an income there, taxable income of 60,927. So you punch the 60,927 into this calculator on the Money Smart website. And on 60,927, it tells us that we've got income tax payable of $10,268, and we've also got a Medicare levy payable of $1,219. So write those two numbers down. We're going to need those two numbers. So you write down your income tax payable and you also write down your Medicare levy payable. And what do we do with those? We put those onto our worksheet. In row 16, we put the tax payable. In row 17, we put down the Medicare payable. And in row 18, we literally add 16 and 17 together to give us our total tax liability. So our total tax liability is now $11,487. So on that $60,000, nearly $61,000 of taxable income, we're paying about $11,500 in tax so far. But, so we've got a 10% tax offset to apply. So we've done step 18, where we've added our tax and Medicare together to give us the $11,487. But now we've got to apply this 10% tax offset. Now the offset only applies for people over 60. Do not try and apply an offset if you're retiring at 56, 57, 58 and so forth. I'm going to give you some examples of how that does, how it works when you are retiring under 60. The offset only kicks in at 60, because if you do take a pension at 55, you don't get the offset initially, but yes, the offset will kick in when you get to 60, and you'll see a pay rise in your pension. So what we do then is we get an offset, and it's 10% of the untaxed amount, which is effectively our taxable income. So we've got this income of $60,927 that needs to be taxed. If we take 10% of that, which is 10 hundredths, or divided by 10, whichever way you want to look at it, but we are taking a tenth of our taxable income, giving us an offset of $6,093. Now, because this pension is what I'm calling a medium pension, it's under these thresholds I'm going to talk about when I start talking about large pensions. The offset, the full offset is applied. Meaning we had a tax bill of $11,487. Our offset is now $6,093. And with offsets, what do? We literally just subtract them from our tax bill. So our tax bill was $11,487. Because we're over 60, we get the offset. We can now subtract, in this example, $6,093 comes off our taxable tax liability. And of course, what are we going to do? We're going to stick those into our worksheet. And so we can put in there, we've got our tax liability at $11,487, row 19, we've got our tax offset, which is the $6,093, and by the time we get to row 20, where we subtract 19 from 18, then we've left with our final tax liability of $5,394. So we've found out the amount of tax that we have to pay. Now we can calculate our net pension, because net pension is literally just our gross pension, which was in this case $107,000. Take off the total tax payable after the offset has been applied. So our net pension in this example is $101,684 net in the hand going into the bank account every year. And of course, if we want to find out what we're getting paid net, then divided by 26, and of course we end up with our fortnightly payment. This person is going to get $3,911 per fortnight into their bank account. We can go back to our worksheet and we just stick in there on row 21 our net pension by calculating our gross pension from row 11 minus the tax in row 20. And then for the last final line there, at row 22, we literally, all we do is we divide it by 26 fortnights to get us our final value, and we've got $3,911 is this person's net pension. Now, of course, from the previous examples of previous episodes, we followed the same person all the way through. And when we were calculating their benefit, it was based on a salary. Their final average salary there was $148,000. So that's what they were earning in gross terms just before they were retiring. So if this person was earning $148,500 or so in those last few years before retirement, they would be paying normal tax on it at that marginal rate. And because their gross is higher, they'd be into the 37 cents the dollar tax bracket. But you can see there their income tax payable was 40 odd, their Medicare was nearly 3, and therefore after tax and Medicare they're really only netting 105. But of course, if they were working away paying this tax and Medicare, they would have also been contributing the 10% into their PSS, and it would have been 10% of their $148,000 salary. Therefore, 10% of the salary is $14,860. You take that off their net pay by working. This person, by working away, grossing 148, by the time they pay tax, they pay Medicare, they pay their superannuation contributions, they're really only bringing home $90,000. No wonder you feel broke sometimes. But yeah, the big chunk of your pay has certainly gone in tax, Medicare and super contributions. Therefore, this person's net salary before retirement was $90,718, compared to the pension when they do retire, perhaps a fortnight later, of $101,684, meaning this person is going to get a pay rise of $10,968 a year to not go to work, an extra $422 a fortnight not to show up. You've got to love the PSS. People grizzle about the tax, but when you look at the tax on employment compared to the tax on the pension and the offset kicking in, the tax problem is, dare I say, quite small. And as we sort of alluded to in previous episodes, if you've got a tax bill here, and you're still paying, a bit of tax on this pension, but you're now getting $10,000 more in net terms, what could you possibly consider doing depending on your overall situation? You could look at the scenario of perhaps taking some of your excess PSS, contribute it, get that right in a minute, as a concessional contribution into another super fund, and you can do that up until age 67, whether you're working or not. And if you make a concessional contribution, you get a tax deduction. That would effectively reduce your tax on your PSS pension even further. The money's gone into another super fund, but because you are retired and you're over 60, when you pull that money back out again, it's tax-free. Okay, so don't dismiss superannuation going forward just because you've got a PS pension. We're going to talk about these things, lots of things, dare I say, in future episodes. But I am going to do some further examples. I say one of a smaller pension and one of a larger pension to show there's a few issues there. And I'll go through all the steps all over again so that it really hammers it home as to how this works. I'm not apologising for repeating certain things in these future ones, literally because this is not easy. And as I say, for some people who are not mathematically excited by all of this, we're here to help do these net calculations for you should you want to do it. Now, because as I say, if you're retiring within 12 months, yes, we can get information from PSS to assist us, but generally speaking, when it's a long way out, these things become an issue. Anyway, join us on future episodes.